Hey, it's Rav. Welcome to Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. I am super excited about today's show. We're going to learn how we can make money investing in apartment buildings. Remember, when anyone offers you any type of investment opportunity, you always want to ask 4 questions to start. Number 1, what's the return on investment? 2, when do I get that return along with the money that I put in? It's very important. If somebody says the return on investment is 20%, but that might mean for the whole duration, so it takes 4 years, it's really only 5% annualized. If you're happy with that, awesome. But you have to ask that question to find out. Thirdly, what is the minimum investment amount needed? And 4th, look them right in the pretty eyes and ask them what is the worst case scenario? What's the downside? Again, we're going to learn how we can make money investing in apartment buildings. We're going to be talking to my good friend Taylor Steele, the guru in this niche of investing.
So I think, when you get into talking about multifamily, obviously the size of the deal increases, and for the everyday investor to go out and find a property, arrange the equity, arrange the financing for an individual acquisition can be a challenge.
Hey everyone, Lee here at Wise Construction. I got a great tip for everyone this week, and what that is, it's water. Water can penetrate your house from above, below, outside, as well as breaching the drain. So one thing we like to do, and I recommend everyone to do, is when you're going to spend your money on doing underground plumbing, make sure you have your plumber do a camera of your drains. And this is to look to see what is outside the house. You can have tree roots, you can also have a collapsed drain. When you finish your property and your basement, to bring water in after the fact will cost you guys an equal amount to redo your basement. So do it proper the first time and get your drains cameraed.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey guys, Omar Khan here from Theta Trading. I want to talk to you today about emotion and investing in the markets. Now, when the markets are doing really, really well, we tend to get very, very high. We're like, nothing can go wrong. And when the markets go lower and they correct, we start thinking the end of the world's coming and nothing can be worse. The idea is to never get high and never get too low. Always remain even-keeled. Stay within your framework. Don't get too exuberant. Don't get too down. Remember, the markets work in cycles. The idea is to be in high quality stocks for a long period of time. Don't let your emotion destroy your investments. Back to you, and we'll see you next week, guys.
Hey, it's Rav. Welcome back to Everyday Investor. We're learning how to make money investing in apartment buildings. I'm with Taylor Steele, and the reason why we're via Zoom today is because you're not in the Ontario area. You're all the way on the west coast of British Columbia. Thank you so much for doing this.
Thanks a lot for having me. Excited to be here. Obviously wish we could be there in person, but over here on the west coast in Vancouver, BC here.
Yeah, I mean, no problem. It's your 3 hours behind, but you guys are busy doing a lot of work in Canada, doing a lot of work in the States. Let's just talk about that. I mean, I know a lot of great returns on investment when it comes to investing in apartment buildings is south of the border. Is it complicated, Taylor, to be able to do that? How are we sourcing these things out? I mean, talk to us a little bit about not investing in our own backyard per se.
Yeah, so I'll give a little background on who we are and what we do. My name's Taylor Steele. I'm over here in Vancouver. I have a real estate brokerage here in Vancouver that I co-founded with my business partner, Cynthia Asen. So we're both licensed real estate agents in the province of BC, helping our clients find deals here. And then we're also registered with an exempt market dealer called Integrated Equities, headquartered out of Toronto there. And we operate in the private equity space, working with a number of different private real estate investment groups. And one of the companies that we work with with has been getting up to some very exciting stuff down in the US multifamily space over the last 7 years. They're a Canadian-based company, but they help investors invest down in the US multifamily space. So today we'll dive into that company and share a little bit more about their opportunities in the US multifamily space.
And Taylor, there's so many different investments out there. I mean, we can look at just buying the single family home and renting it out. What are your thoughts in this, kind of the apartment building space? I mean, it seems like you're out there with the big boys, but the everyday investor can kind of get involved. Talk a little bit about that.
Yeah, so I think, when you get into talking about multifamily, obviously the size of the deal increases. And for the everyday investor to go out and find a property, arrange the equity, arrange the financing for an individual acquisition can be a challenge. And so what the benefit of working with a group like that is you get to piggyback off a company like that has the team in place to acquire these properties, to renovate them, to manage, and you can participate as a passive investor. They have two options for investors to participate. You can participate on a deal-by-deal basis, and the minimum investment for that is $25,000. And then they also have a fund approach where you can invest across a diversified portfolio of their buildings, and the minimum investment to participate in that is $10,000 Canadian, and you can also use RSPs and TFSAs as well.
And so what's kind of like, the process? How do we actually make our money? I mean, we'll go through the numbers when we come back from a break here in a few minutes. But what's kind of the theory, the process? I mean, are we just buy a building and it cash flows, or are we doing something to it, or kind of what's the specialty here?
Yeah, so their specialty is they buy existing buildings and they're going in there to add value. So the typical age of the building they look for is around a 1980s, 1990s building in their original condition, where they can go in there and they can renovate the building. So paint the outside of the building, upgrade the interiors of the units, update the leasing center, the fitness studio. So taking it from that 1990s look and feel up to more modern vibe. And from there, you buy this property, you increase the rents by doing these value add systems within the property. And there's three ways as an investor that you'd receive your return on investment. The first way is you get an annual cash flow distribution on these properties once per year in the November timeframe. So once per year, the property generates the cash flows that it produces. And then the second way investors can receive their money is during the period that they own this building, Western Wealth Capital has the ability to refinance this property and return equity back to the investors through a refinance. So that's the second way that investors make their money. And then the third way investors make their money is when they sell the property at the end of that time frame. They project it between 3 to 5 years. The investors receive their profit sharing on the sale of the building. And so between the cash flows and the sale of the building, right now they're targeting on their current opportunities around a 16% annualized return. And
this is, it's not liquid, right? When I invest, I'm investing in something, and so I can't expect, hey, I need my money out year one. It's tied up for 3, 4, 5 years, or however long it is.
One thing to always consider with private investments is generally they are illiquid. They can be hard to redeem and or illiquid. So one thing to always consider is these are not like your stock portfolio where you can wake up on Tuesday morning and sell 50% of it. It does not have that liquidity aspect. So always one thing to review and consider when taking a look at these style of real estate investments.
ROI targeted around 16% annualized, length of time 3 to 5 years, a minimum investment. I think I heard you say $25,000. What would be any downside? What would be the risk in something like this, Taylor?
So I'll touch on the downside. And obviously with any real estate investment, you've got your general risks, you've got your market risk, your vacancy risk, your financing risk, you've got all of those that come into play. When I take a look at Western Wealth Capital, something I always like to bring up to my clients is their track record. Working with experienced management teams that have a history of doing what they say they're going to do. And when you look at a company like this, they've done 115 individual buildings. They've acquired over 26,000 apartment units, and they've sold 33 of those buildings with inside of their portfolio. And to date, the worst scenario out of the 33 properties that they've sold, the 117 that they've bought, is the worst annualized return for the investors was 11% on each of those 3 deals that produced each 11% annualized over the time frames. So on their downside, again, it was below their projected returns of what they were targeting. but still in the double digits on an annualized basis. But again, there is always risk going into these investments.
Talk to me a little bit about, I mean, it's, kind of the Securities Commission. I mean, just touch on it for a second. These opportunities are regulated, governed, I'm not sure what the word is. Talk a little bit about it, and why is that, would you say? Like, why can't just the everyday investor, like anybody, be able to get into a deal like this?
Yeah, that's a very, very good question. And on that point, quick disclaimer, past performance does not guarantee future results, and all investments have risk with associated with them. Please review and understand those risks. And to touch on your point, I think the Securities Commission is put in place to protect investors. We have a duty as dealing representatives to make sure that this investment is suitable for people based on their financial situation, based on their risk tolerance, based on what other investments that they own, whether it's public, private investments, stock investments. So it's important for us as dealing representatives to paint the full picture of who the client is, get more information on them, so we know that when they're purchasing this investment, it fits within their threshold of timelines, of risk tolerance. Maybe they have $50,000 to their name. We want to make sure that they don't deploy that all into one single investment.
And somebody just gives you, a call, an email to find out if they're suitable, or if this fits, for them based on, again, what's governed?
We have what's called a Know Your Client form. This is a document that allows us to gather this information on the client, your work information, where you've worked, what type of work experience you have, your investing experience, what type of investments you've worked with in the past, whether that's stocks, fixed income, real estate, whatever that may be. And then also understanding kind of their objectives, where they'd like to be, what kind of risk tolerance they have, how long they'd like to be in these types of investments. So if someone comes to me and they're 75 years old and they want a 2-year investment, maybe a 5-year play down in the United States isn't the right fit for their current portfolio. So it's important to match the type of investment that they're making with the right type of client. And we've been in situations where we've had to tell people to say, hey, based on where things are at right now, this isn't the right fit for you currently.
Mm-hmm. Great stuff, man. Let's look at one of the case studies. We'll go through the numbers. Thank you so much for being on the show with me. Guys, don't go anywhere. We're with Taylor Steele. We'll be right back.
Thanks. This week I want to talk about the 4 tiers of lenders. Most investors are familiar with A lenders. These are our big banks and institutional lenders. They have the best interest rates when it comes to financing, which generally is going to mean the most cash flow for you as an investor. Now, the downside of the lenders is they can be the most stringent when it comes to qualifying, the most income docs, paperwork, and overall tight lending guidelines. Whenever possible, we want to get an A lender, but let's not let that be the be-all and end-all of getting our financing. Let's talk B. B lenders are still institutional. The rates are only a little bit higher, and they have a much broader lending guideline. They will use more rental income as a percentage in your portfolio. They'll lend on different types of income, so self-employed income for less than 2 years. And they can be more flexible in terms of borrowing down payments or asset type. Next, we have C lenders. C lenders are what we consider MICs. A MIC stands for Mortgage Investment Corporation. What a MIC is a private lender that has been institutionalized. They still likely have an office, staff, formal paperwork, and they are a large fund that lends on real estate. MICs are generally even more flexible than B lenders in terms of lending criteria and guidelines, and though their rates are a little bit higher, they can be a great tool used for acquisition. The fourth and final is individual private. So this is the quote-unquote Bob and Mary homeowner, the standard couple that's lending out of their own resource to lend on private deals. They're not institutionalized, and they can generally be the most flexible in terms of lending terms. If you have more questions on the tiers of lenders and how you can structure your deals differently to qualify in different lending guidelines, don't hesitate to reach out to myself and the Kyle Ford Mortgage team. Thanks, and have a great day.
Blackjack Contracting Inc. is a premier contractor for real estate investors, having transformed over 250 single-family homes into multiple legal suites. Blackjack is proud to introduce their newest venture, reicontractor.ca. Check out reicontractor.ca to get support with planning, design, renovation services from the most experienced real estate investor contractors. reicontractor.ca, powered by Blackjack Contracting.
Hey, it's Rob. Welcome back to Everyday Investor. We are talking to my friend Taylor Steele all the way from Vancouver, British Columbia. We're learning how to make money investing in apartment buildings. Taylor, thanks for being on the show with me, man.
Rob, thanks a lot for having me. Really appreciate it.
Yeah, I mean, the whole essence of Everyday Investor is a lot of times people are challenged because they take their precious time, they go to work, they make money in order to eat. And to go to work is a good thing. I think we're blessed to be able to work. But, imagine a life where money could make you money. And that's why I kind of like these, passive investments, because over time, you start to see, the compound effect, if you will. And so I love it. I love where you can make some great returns and you don't really have to do any work. They're kind of passive investments, but with, double-digit returns. So thanks for being on the show and teaching me. We're going to look at one of the apartments buildings. Where is this one located?
So this is a property that was purchased in Phoenix, Arizona back in 2018, in July of 2018, and was sold in June of 2021. So we'll be walking through a case study of a multifamily property there in Phoenix.
And you said you bought that in 2018 and it was sold when?
So July 2018, it was purchased, and June 2021, the property was sold. So just about 3 years.
Okay, so about 3 years time. All right, so on this particular investment, what was the annualized return?
So the projected annualized return when they were going into this project on a 3-year exit and a 5-year exit was a 19% annualized return was what they were targeting going into the deal.
Okay. And then what ended up happening?
What ended up happening was the deal sold in 2021, and the annualized return back to the investment partners was approximately 35% per year.
35%, so almost double. I'm sure they were thrilled. So you're saying about 35% annualized. Okay, so how did this happen? Teach us what, when we're investing and here's our building. Was it just one tower or how many?
It was a multi-unit building, garden style apartment building, a couple hundred units there in Phoenix. And so the acquisition price to acquire this property was $16.5 million was the purchase price.
16.5 was the buy. 16.5 mil. Okay. Then?
So the down payment, the equity required for the property was $4.95 million.
So this is where Rav and friends would come up with this money?
Correct. So I'll get into the total equity raise, but this was the equity required for the down payment. And then the total equity raise incorporates 3 additional items. You've got your legal and closing costs for about $400,000. You've got your general partner fees, which include the equity raise fee and the acquisition fee that they charge. And then you've also got your money that you raise for the capital expenditures, which goes towards the renovations on the property. So your legal and closing costs are about $400,000. Your general partner fees are about $640,000. And the capital expenditures for the renovations on the property was about $1.2 million. So the total equity raised, including the down payment, was $7,275,000 for this particular property.
How much?
275.
275. That's what was needed total. Okay. So just over $7 million was what was needed total. That includes, the renovations, the legals, the down payment, and then what happened?
Yeah, so the minimum investment to participate in a deal like that is $25,000. So to touch on your point there about large scale projects, and you can participate with as little as $25,000. So their business plan when they acquire this property is to renovate and transform the building. And so that's everything from exterior renovations on the property to interior renovations with inside of the units. So your leasing center, your clubhouse, new pool furniture, updating the paving in the parking lot, painting the outside of the building, new signage, new kitchen inside. So all of that capital expenditure money that they raised for is getting used to deploy into the renovations. And so when they do those renovations, that allows them to charge additional money per unit more in rent. And people don't have a hard time paying more money for rent if they're getting something in exchange. So they're getting a nicer inside of the unit, they're getting a nicer exterior of the building. So that $1.2 million was used to renovate and transform the exterior of the building. And so, as I mentioned, there's three ways that the investors get their cash flow. So the first year that they owned it, they purchased it in July, and then they sold it. Then they received cash flow distribution in November. So from July to November, they received a check for just under 1% in the first few months of ownership. So within 3 or 4 months, they received a distribution on their cash flow. And then the second year, they received another cash flow distribution for about 5%. And then in 2020, they received another cash flow distribution for 8%. So each year, the cash flow distribution back to the investor increased as they continued to increase the rents at the property and drive the overall net operating income of the property.
And what would be the average that we spend on each unit, would you say? 5,000, 7, 10, 15?
Yeah, so that's one thing that they're very cautious of in the value add space is what's the right amount of money to spend to get the most amount of rental increase in relation to that. Now, if you go and spend $15,000 inside of a unit and you put granite, everything, marble flooring, the bells and whistles, are you going to get that much more additional rent at your unit if you were to just put in vinyl plank flooring, redo the countertops, redo the cabinets? And so they're spending approximately $5,000 to $6,000 on the interior renovations inside of these properties. They're not up there spending $12,000 or $15,000 on the inside of these units.
Okay, so $5,000 per unit, maybe a little more in some cases, and then how much can I increase the rent by?
Yeah, so
if I do this.
So they pro forma about $125 to $150 per month of additional rent for an upgraded unit.
Okay, so $125 more rent. And this is where I just want to stop for a second, because really it's not about this. It's the purchase price of this property was, would you say 7 million? No, that was all the fees.
16.5 million.
16.5 million. Once we've done this, I mean, a lot of people, mom and pop who own an apartment building would be like, are you crazy? I'm not going to spend $5,000 per unit just to get $100 out. But we're not talking about that. We're talking about this is now not worth 16 million. It's now worth what when we sold it?
Yeah, so the property when it was sold for just over $31 million.
So we doubled the market value in 3 years by doing this. And so that's what, if you can talk us a little bit about that, about the cap rate and how it spits out value by increasing the rent. Can you walk me through that a little bit?
Yeah, I think it's a really important formula for everyone to understand, and it is a formula. So what a cap rate is, it's a formula that's determined by the net operating income. So that's the income that the building produces before the mortgage payments. So your net operating income divided by the property value will produce you what the cap rate is. And a cap rate is what comparable buildings in that neighborhood have sold for. So if you've got a cap rate and you've got your NOI, that will determine your building value. If you've got your building value and a cap rate, that will provide you with the NOI. So it's a three-way formula that is used to determine the value of the building. And I think the experiment of showing is in each dollar, when you increase the net operating income, what that net effect is to the overall property value. each dollar you continue to increase on a net operating income basis. And you can do that two ways. You can increase the revenue that the building produces by charging more for rent, by upgrading these units. And you can also do this by decreasing the expenses of the property. So there's two ways to drive NOI, increasing revenue and decreasing expenses. But it's amazing to see how impactful each dollar of net operating income addition to the property is, in turn, how much value that can drive for the overall property.
Okay, so give me those numbers. So let's just take $100. Let's say I spent $5,000 and I increased by, I think you said 125, 150. Make numbers easy. Let's say $150, and we want to do that times 12, right? So that would be $1,800. This is just one unit. Is that right?
Correct. Yeah. So $1,800 on an annual basis, and say that the market cap rate was 5%. Use 5% for a number there.
So 5%. So that means that all things in that area, the capitalization rate is 5%. That's how we kind of just view that area. And so you're telling me if I take $1,800, which is $150 more per unit per month times 12, $1,800. I divide that by the cap rate of 5%. That spits me out an additional value of how much?
Based on my numbers here, approximately $36,000.
$36,000. So $36K. That's why I do what maybe, mom and pop don't necessarily know. Like, I'll spend $5,000 now on this formula if it's going to spit me out 36. And you're saying when you look at this, Taylor, and you multiply it by hundreds of units, now we can see how we can, double the value in 3 years in this case.
Yeah, I think, when you originally slated down the numbers, you said $125 per month, which is $1,800 per year at a $5,000 investment. All of those numbers seem relatively low compared to the value creation you just achieved from spending that $5,000 on the property to get another $36,000 of value to the building. And really what they call the multiplier effect in multifamily is the fact that you now have 150, 250 units where you can go and execute this on. And that $36,000 is then multiplied across many, many units across the building.
Yeah, and that's if we increase it by $150. Sometimes we might increase it by 200, 250, 100. It all depends. But the point is, if we increase, our income, and I didn't even look at, when we buy these apartment buildings, I'm sure we're looking at underperforming, undermanaged. So then we can also decrease the expenses. Now we have a big margin in there, divide it by the cap rate, and that spits up our value.
You got it.
Yeah. Okay. So this is why a lot of players like this space, and this is why a lot of players, it gives them a headache, but they like to write a check into this space, such as yours truly. To be able to find these types of properties, I'm sure is not easy. I mean, there's probably a whole acquisition team that the people that you work with, and it's not just the Western Wells. There's people like right here, the Graybrooks. There's so many different people that are kind of in this space. They have a big team looking for this kind of stuff. Yes.
Yeah, that's one thing that a lot of people don't see is the behind the scenes. I think they see how frequently a company like Western Wealth or a company like Graybrook brings offerings out to the marketplace, on a monthly basis per se. There's a lot of layers that go on behind the scenes in terms of looking at a lot of bad deals to find the good ones for investors, and just really a lot of analysis and process of elimination before they bring those offerings out. And so I think a lot of people see the frequency of the deals that these companies provide to investors, but they really don't see how much manpower and behind the scenes work goes into bringing those offerings out to investors.
Yeah. Listen, time flies when you're having fun, when you're being educated. Thank you so much for nurturing me and the viewers. Very grateful, Taylor, for you to be on the show with me.
Thanks a lot for having me, Rav. That was a lot of fun.
Yes. And thank you guys for watching at home. Without you, we would not have a show. Make sure you tune in next week. Same place, same time. Honey, love you. I'll be home soon. Bye, everyone.